You know that moment when you just knew, maybe a gut feeling about a stock, a trend you saw brewing, and, well, you turned out to be right.
Yeah, happens all the time.
But somehow, the big win just slipped through your fingers.
Yeah.
Maybe you jumped in too soon, or maybe you hesitated and kind of missed the boat entirely. That frustrating gap between a correct prediction and actually making a profit, that's really what we're digging into today.
Yeah, because it turns out in investing, just being right, well, it's often only half the battle, isn't it?
Exactly. Timing, as we're about to explore, can be the deciding factor. It's crucial.
It really is a critical point. So today's deep dive is all about understanding why the when of your investment decisions can be just as vital, maybe even more vital than the what. We'll look at some really compelling stories where, spot-on analysis actually led to pretty costly outcomes simply because the timing was off.
And we'll see the other side, too.
And we'll also see how masterful timing can amplify even sort of straightforward investment ideas.
Okay, and we've got a fascinating set of examples to unpack here. We looked at cases where investors correctly saw big market shifts coming, but still faced significant losses.
Right.
Then there's the remarkable career of a legendary investor, a real master of timing, but who also made some crucial missteps. That's interesting, too.
Yeah, shows nobody's perfect.
Definitely. And then there's the, let's say, the often murky world of financial media and that ongoing debate. Should you even try to time the market?
Or just stick to a long-term plan, especially when things get volatile, like with Bitcoin.
Exactly. So our goal today for everyone listening is to really get under the skin of why timing is such a make-or-break element in investing.
We want to learn from these real-world experiences, understand the subtleties involved, and hopefully give you some practical insights, things you can actually use to navigate this tricky area in your own investment journey.
Right. Aiming for actionable understanding, not just, abstract theory. Okay, let's unpack this core idea that kept jumping out at us. Being early is the same as being wrong. It sounds kind of brutal, doesn't it?
It does, but the examples we looked at really hammer this home.
Take Julian Robertson from Tiger Management. This is a guy who saw the dot-com bubble inflating back in the late 90s. He knew it couldn't last.
Smart guy. Saw the writing on the wall.
Yeah, and he actually shorted a bunch of tech stocks. Now, that sounds like smart investing, right? Based on his analysis.
Absolutely. I mean, his fundamental analysis was sound. He correctly identified those crazy valuations in the tech sector.
So his prediction was spot on.
Totally correct. The dot-com bubble did burst eventually.
Right. But here's where the timing just, tripped him up completely. Robertson made his bet way too early. For like 2 solid years, these tech stocks just kept soaring, completely ignoring his, logical assessment.
Yeah, defying gravity.
So his funds started racking up pretty significant short-term losses. Now imagine being one of his clients back then.
Oof. Yeah, watching your money go down while everyone else is bragging about their tech gains.
Exactly. Understandably, they started pulling their money out big time.
The pressure must have been immense.
And the real kicker, he was basically forced to close his fund in March of 2000.
March 2000, wow.
Just weeks, literally weeks before the market finally tanked. He was right, fundamentally right, but the timing of his move, disastrous.
It's incredible. The core insight there is that even with, perfect foresight, acting too soon can ruin you. Market irrationality, client pressure.
Yeah, especially the pressure from impatient investors in his fund.
And that perfectly illustrates that famous Keynes quote, doesn't it? The market can stay irrational longer than you can stay solvent.
Oh, absolutely. That quote just nails the danger of being too early.
It really does. You can have the most accurate long-term view, but if your capital, evaporates before that view becomes reality, well, it just doesn't matter, does it?
Doesn't matter at all. And it wasn't just Robertson, was it? We saw a similar story with Tony Dye.
Right. Tony Dye at Phillips & Drew. He was ringing alarm bells about the market way back in 1995, predicting a big correction.
So, like Robertson, he acted on it. Positioned his portfolio very defensively. Now, being prudent sounds good, but...
But again, like Robertson, Dye acted way too early. His cautious approach meant years of underperformance, while the market just kept booming.
Investors must have been pulling their hair out.
Oh, you bet. They grew frustrated missing out on those huge gains, and he was ultimately dismissed in early 2000.
Early 2000 again. That seems to be a key time frame.
It is, and what makes Dye's story particularly, kind of tragic, is that the market actually crashed just days after he lost his job.
No way.
Yeah, he was proven right, just like Robertson, but the mistiming of his defensive stance cost him his career. It really raises that question, when does being a visionary too early just look like being plain wrong to the market?
It's almost like a Greek tragedy. His analysis was spot on, but the timing cost him everything. Okay, then you have someone like John Hussman.
Hussman funds.
He correctly anticipated both the 2000 and the 2008 crashes. You'd think, okay, that's the recipe for legendary investing success, wouldn't you?
You would think. Hussman certainly showed exceptional skill in spotting those major downturns, no question about that. But the crucial lesson from his experience isn't just about predicting the crashes, it's the persistent mistiming of the recoveries.
So he stayed negative for too long afterward.
Exactly. He remained consistently bearish, overly cautious, even as the market started its climb back up after those collapses.
So he missed the rebound.
Missed significant gains during the bull markets that followed. His funds really underperformed over the long haul because of it. It highlights that even being right about the big falls isn't enough if your timing stops you from participating when things turn around.
So, okay, the big takeaway here seems pretty clear.
Yeah.
Accurate analysis is like only half the equation, maybe less than half sometimes.
Could be. The timing of when you actually act on that analysis, when you place your bets, it's just absolutely critical. It can be the difference between winning and losing, even if your initial idea was totally correct.
Yeah, it's not just about being right, it's about being right at the right time.
Precisely. These examples really show the multi-layered risks of getting the timing wrong. You can sell too early, miss huge gains, even face financial ruin, no matter how good your initial homework was.
Markets are just complex, dynamic beasts, aren't they? Driven by more than just logic.
Absolutely. Psychology, momentum, flows, a whole range of factors.
Okay, now let's shift gears a bit. Let's talk about someone who's often held up as one of the all-time greats, Stanley Druckenmiller.
Yes, Druckenmiller. His long-term track record is just, phenomenal. Something like 30% average annual returns for 3 decades without a single losing year. That's legendary stuff.
Seriously legendary. So what's his secret sauce when it comes to timing?
Well, what's fascinating about Druckenmiller is his philosophy. He really emphasizes being patient, waiting for those really high probability moments.
Okay, patience first.
Then acting with real conviction. Betting aggressively when he truly believes the odds are stacked in his favor. And maybe most importantly, he's known for an incredibly disciplined approach to managing risk.
Right, that famous 1992 bet against the British pound with George Soros. That seems like a perfect example of that high-conviction, well-timed trade.
Absolutely. They reportedly made $1 billion in a single day. That shows incredible timing, yes, but also that deep understanding of global economics, politics.
The whole macro picture.
Exactly. But his consistent success isn't just about those huge headline-grabbing trades. He's shown this remarkable ability to constantly adapt.
Adapt to what?
To shifting market sentiment, changes in central bank policies, adjusting his positions quickly in a timely way, his skill in reading the market signals and then acting decisively, that's been key throughout his career.
And the risk management part seems just as vital. Our sources mentioned his strategy of really leaning into winning trades, letting winners run big, but also being incredibly quick to cut losses.
Yes. Ruthlessly quick.
That sounds crucial for managing timing, doesn't it? Knowing when to double down and when to just get out fast.
Absolutely vital. That flexibility, that willingness to admit you're wrong quickly if the market moves against you. It prevents small mistakes from becoming catastrophes, especially if your initial timing wasn't quite perfect.
Okay, but even a titan like Druckenmiller isn't immune to timing errors, right? The dot-com bubble. That was an interesting chapter for him.
Oh, yes. A very interesting and perhaps a bit humbling chapter. He initially recognized the overvaluation, just like Robertson, started shorting internet stocks.
But like Robertson.
He was early, and that early shorting led to substantial losses as the bubble just kept inflating, defying his logic.
Okay, so what did he do then? Stick to his guns.
Well, this is where it gets really insightful. His reaction to those losses, he actually reversed his position. He started buying tech stocks.
Buying at the top, why?
Driven, it seems, partly by that fear of missing out FOMO and the emotional pressure of seeing everyone else making fortunes while he was losing money shorting.
Wow. So emotion got the better of him.
It appears so. And that emotional decision to jump in near the peak, even though his earlier analysis screamed bubble, reportedly led to a staggering loss when it finally burst.
Yeah.
Something like $3 billion.
$3 billion. That's a powerful reminder, isn't it? Even the best, most disciplined investors can get swayed by emotion and make critical timing errors.
Druckenmiller himself has admitted that his emotions kind of overrode his usual discipline analysis during that period. His experience really underscores a crucial point. Sharp analysis and precise timing are essential, sure. But maintaining that emotional control, especially during those times of extreme market euphoria or panic, that is incredibly difficult, maybe the hardest part.
It really humanizes these investing legends, though, doesn't it? Shows they aren't infallible. They can fall victim to the same timing pitfalls that trip up, well, the rest of us. Now, this kind of leads us to an interesting contrast we looked at. The world of financial media personalities versus, say, professional investors.
The TV gurus versus the fund managers.
Right. It's so easy to get caught up in the predictions, the hot tips you hear on TV or read online. But are their incentives really aligned with helping us time the market effectively?
That is a really, really important question to ask, because when you actually examine the track record of many prominent financial media figures, like Jim Cramer, for instance.
Mad Money guy.
Yeah, studies have actually shown that his stock picks, and those of others like him, often underperform basic market benchmarks over the long term.
Really? Underperform the market?
Often, yes. Which should definitely give listeners pause if they're relying heavily on these sources for timing their own investment decisions.
And when you think about how these media personalities actually make their money, it's different, isn't it?
Very different. It's often not directly linked to how well the investments they talk about actually perform. We learned someone like Cramer earns a huge salary from CNBC, plus book deals, appearances, brand stuff.
So their income isn't tied to investment returns.
Exactly. Their primary income streams are usually tied to viewership, ratings, engagement, not necessarily the profitability of the advice they're giving out. The incentive is often to be entertaining, generate buzz, be controversial sometimes.
Which might not always align with sound, consistent, accurately timed advice.
It can sometimes come at the expense of that, yes.
Whereas professional investors, I mean, the ones actually managing money for clients, they're held to a totally different standard, right?
A vastly different standard. Their personal wealth, their entire business model, is directly tied to their performance. If they make consistently poor calls, if they repeatedly mistime the market,
Clients leave.
Assets under management shrink, the business suffers. There's very real, direct financial accountability there.
That's a huge difference.
It's a key distinction. Professional investors face immediate, tangible financial consequences for messing up. Media figures, mostly reputational consequences. They can often keep their shows as long as they stay popular, even if the calls aren't great.
So it's often entertainment first, efficacy second.
You could argue that. The emphasis can lean more towards entertainment value than genuine, consistent investment efficacy.
Okay, so the key takeaway here for everyone listening is be really discerning. Think about where you're getting your financial info. Understand the different motivations behind it.
Precisely. Someone whose main job is to entertain you on TV might not have the same pressures or goals as someone whose livelihood depends entirely on generating actual investment returns. It's just different games.
Not all market commentary is created equal.
Not by a long shot.
Okay, this then leads us naturally to that big ongoing debate. Should we even be trying to time the market at all? Or is a long-term investing approach just generally the more sensible strategy?
The million-dollar question.
Especially when you consider the kind of extreme volatility we see in some assets, like Bitcoin, for example. This question feels even more relevant, doesn't it?
It really does. And the pitfalls of actively trying to time the market, well, they're pretty well documented. Successfully predicting both the perfect time to get out before a downturn and the perfect moment to jump back in before the recovery. It's incredibly difficult.
Even for the pros we've been talking about, like Druckenmiller.
Exactly, even for them. And numerous studies consistently show that investors who miss even just a handful, like 5 or 10 of the market's best performing days, their overall long-term returns can be significantly slashed.
And those best days, they often pop up when you least expect them, right?
Yeah.
Like right after a big drop.
That's the cruel irony. They frequently happen right around the lowest points of a bear market or during those really sharp, fast recoveries. Exactly the times when someone trying to time the market might be sitting nervously on the sidelines in cash.
Too scared to get back in, and they miss the rebound.
And missing those sudden bursts of positive performance, that's absolutely crucial for long-term growth. It can be incredibly costly to miss them. The very volatility that tempts people to time the market also creates these essential upswings.
Okay, so that's the case against market timing. What about the other side, the long-term approach?
Well, the long-term investing strategy really emphasizes the power of just staying invested. benefiting from overall economic growth over decades, the magic of compounding returns, reinvesting dividends.
Time in the market, not timing the market.
Exactly. That well-known saying really captures the core idea. Over the long run, fundamentally sound businesses and economies tend to grow, assets tend to appreciate, and a patient approach lets investors ride out the inevitable short-term bumps.
And benefit from the long-term upward trend.
Right.
And the Bitcoin example you mentioned earlier really seems to highlight this challenge, doesn't it, with that kind of volatility?
Oh, absolutely. We've seen these massive price swings, huge crashes, incredible rallies. Anyone who tried to perfectly time their Bitcoin entries and exits has likely experienced, well, a lot of frustration. And probably significant losses too. Whereas many people who simply bought Bitcoin and held on for the long term, even through those gut-wrenching crashes, have often seen very substantial gains over time.
Hence that saying you hear from Bitcoin folks, don't wait to buy Bitcoin and wait.
Exactly. It illustrates that even with highly speculative, volatile assets, the long-term holding strategy can often outperform trying to make tricky short-term timing calls. The long-term trend, if positive, can potentially outweigh the risks of mistimed trades.
So Bitcoin's volatility is kind of like a supercharged version of the broader market's unpredictability.
In a way, yes. It serves as a powerful reminder. The potential for quick gains through clever timing might seem tempting, but the risk of getting it wrong or missing those big upward moves is just really substantial.
So, okay, is it totally black and white then? Is it either aggressive market timing or just purely passive buy and hold forever? Or are there maybe some middle ground balanced approaches?
Yeah, that's a great question. Many successful investors actually use hybrid strategies. They might have a core portfolio of long-term holding stuff they believe in for the next 5, 10, 20 years.
The foundation.
Right, the foundation that aligns with their main financial goals. But they might also make some moderate tactical adjustments around the edges based on their broader market view or specific opportunities they see. Not huge bets, but tweaks.
Okay, so core and explore, kind of.
Something like that. And another really effective and often less stressful approach is dollar cost averaging.
DCA. Investing a fixed amount regularly.
Exactly. You invest, say, $100, $500 every month or every 2 weeks into your chosen investment, regardless of the price at that moment.
How does that help with timing?
Well, it automatically makes you buy more shares or units when prices are lower and fewer when prices are higher. It smooths out your purchase price over time and takes the guesswork and emotion out of trying to decide when the perfect time to buy is.
So it mitigates that timing risk without you having to predict anything.
Precisely. It benefits from market dips automatically.
So it sounds like while trying to nail the absolute perfect moment to buy or sell is incredibly difficult, maybe even impossible consistently.
Extremely difficult, yeah.
Having a disciplined long-term view, or maybe using a balanced strategy like DCA, something that incorporates patience and avoids those emotional knee-jerk reactions to market noise. That seems like a much more sustainable path.
And ultimately, often a more rewarding path for most investors, yes. It leads to better risk-adjusted returns over the long haul, generally speaking.
It's about focusing on the long game, maybe, not getting completely sucked into the short-term drama.
Exactly. Avoiding that often futile attempt to perfectly time every market wiggle.
All right, let's try and bring this all together then. We've seen some really powerful examples of why just being right with your investment idea isn't enough.
Timing is crucial.
Absolutely crucial. We've looked at those cautionary tales, Robertson, Dye, Hussman, smart people who made correct predictions but got the timing wrong, sometimes disastrously so.
Painful lessons there.
Then we explored Stanley Druckenmiller's incredible career, seeing both his mastery of timing and how even he could fall prey to emotional timing errors during that dot-com mania.
Human, after all.
Yeah. And we contrasted the incentives driving financial media personalities versus professional investors, why you need to be critical of your information sources.
Super important. Understand the motivations.
And finally, we dug into that classic debate, market timing versus long-term investing, using Bitcoin as a really stark example of volatility, and touching on balanced approaches like dollar cost averaging.
And the big picture, I think, is that while that dream of perfectly timed trades is really alluring, it's just a very, very difficult game to win consistently.
It seems almost like gambling sometimes.
It can feel like it. The evidence really stacks up, suggesting that for most people, a disciplined, long-term approach, maybe blended with some sensible strategies like DCA, focusing on patience, avoiding panic, That often leads to better outcomes, better risk-adjusted returns over time.
So for everyone listening, maybe the final thought is this. If even the most brilliant, experienced investors on the planet can really stumble when it comes to timing,
And they do.
what small, consistent adjustments could you maybe make to your own investment strategy? Adjustments that prioritize that long-term growth and resilience over the often elusive temptation of trying to make that perfectly timed trade.
Yeah, what if the real edge isn't predicting the future with crystal ball accuracy? What if it's more about patiently navigating the inevitable ups and downs that the future will throw at us?
Having a plan and sticking to it with a clear, long-term perspective, definitely something important to think about.